Okay, today we're going to talk about current liabilities. These are obligations of our business. We owe other people either money or service. Definition of a current liability is that it has to be paid back if it's an amount due within 1 year or less, or in the case of unearned revenue, we've been paid in advance. We have to provide a service to our customer within 1 year. These are our most common current liabilities. Accounts payable, notes payable, unearned revenue, interest payable, taxes payable, wages payable, you could have utilities payable, and there could be others, vacation payable for your employees. So there are a variety of short-term or current liabilities. These are some of our more common non-current liabilities, which is more commonly called long-term debt. Okay, and they're due beyond 1 year. Notice we have notes payable down here as well. Bonds payable, mortgage payable for real estate, lease liabilities if you lease equipment on a long-term basis, pension liabilities for employees. There could be deferred income taxes which are due 2 or 3 years from now. So we have a variety of different non-current liabilities as well. And in accounting, we have a very strict cutoff. If something is due, we have to pay something at 1 year, it's current. If it's due 1 year plus 1 day, it's non-current. And that's literally how we determine current from non-current. Same thing with assets. Okay, now, I want to first look at notes payable, because notice we have it in the current section and the non-current section. And really, it's up to the bank, we'll assume the loan is from a bank, and us as to how we structure this loan, how we set it up in terms of when it's going to get repaid. Okay? So let's take a look at this example. On January 1st, we sign a 3-year, $300,000 note payable. It's called a promissory note. We promise to pay it back. We're going to pay 10% interest, and we're going to make 3 payments on January 1st of year 2, January 1st of year 3, and January 1st of year 4. Those are the 3 payments that are going to be made back, and we're going to pay back 1/3 of the loan principal. The principal of the loan is $300,000. So each year, we're going to pay back $100,000 plus interest on the portion of the loan that is outstanding. General rule with interest on any loan is that you only pay the interest on the portion that is outstanding. I'm going to put a timeline on the board so we can keep track of this. Here's the end of year 1, end of year 2, end of year 3. Each year, we're going to pay back $100,000 plus interest, and we'll plug in that amount as we calculate it. Okay, so here is today, right here, we borrow $300,000. We've agreed to pay 10% interest, and this is how we're going to structure the loan. So on day 1, when we borrow the money, we debit cash, asset, credit notes payable. Now, this note payable is current and non-current at the same time. And the way we describe it on the balance sheet, is in the current liability section, we'll say note payable current portion, or the current portion of notes payable, however you want to describe it. And then in the non-current section, we'll simply say note payable. We don't have to say non-current portion. It's implied. And when we say note payable current portion, this tells us that this note payable in the current liability section is really part of the note that's identified in the non-current portion. There's one loan. We've simply split it up into 2 parts because part of it is due within 1 year and the remainder is due beyond 1 year. We're going to put the interest payable on this note in a separate account. So let's go ahead and take a look. On December 31st of year 1, assuming our business year, our fiscal year end is December 31st, we're going to have to accrue interest. This is an adjusting journal entry because we've incurred 1 year's interest. Now, on today, we have owed $300,000. Well, we borrowed $300,000. Here we are on December 31st. So I have to calculate 10% interest on $300,000, which you should be able to do pretty easily. That's $30,000. So I'm going to I'm going to accrue $30,000 interest at December 31st of year one, because the matching concept, where we have to put expense in the proper time period, this expense, this $30,000, was incurred in this year. So we have to report it on that year's income statement. It's not going to get paid till tomorrow, the very next day, which is January 1st, but that's January 1st of year two, new time period. So my adjusting journal entry on December 31st to accrue interest is debit interest expense and credit interest payable. Now remember, interest expense, any expense account gets closed out. It's a temporary account, gets reported on the income statement, it's going to get summarized into the income summary, and then ultimately it goes into retained earnings, and then we clear it out. We set it back to zero for the new time period. Interest payable is a liability. As a result, that's a permanent account. It does not get closed out. So we're going to have a liability of $30,000 on the balance sheet, and the very next day, January 1st, we're going to pay that off, because here, January 1st, year two, we're going to pay a total of $130,000. Here's the entry. Okay, I'm sorry, this is the balance sheet presentation for December 31st. Interest payable, current, obviously. We're going to pay it one day later, $30,000. Note payable, current portion, $100,000. And then notice under non-current liabilities, we have note payable for the remaining $200,000. On the income statement, interest expense, $30,000, typically will be reported below operating income in the other expense section of the income statement. So this is our financial statement presentation if you were to prepare financial statements. Okay. Now, on January 1st of year two, here's our journal entry. Okay, it's a little bit not lined up here accurately, but we're going to debit interest payable, liability, because we're paying it down, and we're going to debit the note payable for $100,000, and we're going to cut a check for $130,000. Okay? So we're going to debit, and I'll try to get this slide corrected here. We're debiting interest payable for $30,000, debiting note payable for $100,000, crediting cash for $130,000. Okay? So that's going to leave us now at the beginning of year two. We're going to owe $200,000 for the coming year, which means at the end of year two, we're going to have to accrue $20,000 interest, okay, which is simply 200,000 times 10%. Okay, again, you only pay interest on the outstanding portion of the note. And since we've paid off 100,000, we still owe 200,000. We'll accrue 10% of the 200,000 that we still owe. End of year two, right here. Remember, I have to prepare financial statements on December 31st, end of the year, and then one day later, January 1st of 03, we're going to actually make that second payment. So on my December 31st 02 financial statements, okay, after I've accrued interest, and here's my adjusting entry at year end, debit interest expense, credit interest payable for $20,000. Balance sheet presentation, interest payable current, $20,000. Note payable current portion, which is going to get paid tomorrow, $100,000. And then in the non-current or long-term section for liabilities, note payable $100,000, which is that third and final payment, which is due beyond 1 year. On the income statement, I would report interest expense of $20,000. Okay? So we make that second payment January 1st of 03, debit interest payable 20, debit note payable 100, credit cash of 120. And notice we now owe $100,000 for the last year. Okay? At December 31st of the last year, okay, since we've made our second payment for the third year, we only owe $100,000. At December 31st of year three, $100,000, put it down here at the bottom, $100,000 times 10% is $10,000. I know you can do that in your head. Okay, so at year end, I'm going to accrue $10,000 interest expense, which is going to go on the '03 income statement, okay? And although I don't have a slide for it on the balance sheet, we're simply going to report note payable in the current liability section for $100,000. We no longer have a non-current portion. It's gone. As a result, I don't have to say note payable current portion. I simply owe one more payment of $100,000. I'm going to pay it tomorrow. And so in the current liability section, note payable, $100,000. Don't say current portion, and because that makes reference to a non-current portion, and we don't have a non-current portion. And on the income statement, I would report $10,000 of interest expense. Okay. Last day, this is a new example, but on January 1st of '04, we simply debit interest payable for 10, debit note payable for 100, credit cash for 110,000, and the note's gone. It's repaid, get it off the books, we're gone. Now, a note payable can simply be a short-term or current liability. So let's take a look at another example. I'm going to erase the board here for a new example. And this note payable is for $80,000. And notice we borrowed it on October 1st. It's a 150-day loan, which is about 5 months, and we're going to be charged 8%. So I'm going to put another timeline on the board. Okay, here's October 1st. Okay, October, November, December. Here's December 31st, end of the year. January, February, March, 1, 2, 3, 4, 5. So March 1st is the due date or the maturity date. And on the maturity date, we're going to pay back the full $80,000 plus 5 months interest. Okay? So on October 1st, when we borrow the money, we debit cash, excuse me, credit notes payable. And now December 31st, 1, 2, 3 months later, I have to accrue 3 months interest, okay, for the months of October, November, and December. So I have to calculate 3 months interest. $80,000 times 8% is $6,400. This is annual interest. Okay. And then I have to divide this by 12 months. And this is going to give me $533, which is monthly interest. And since I have to accrue 3 months interest for October, November, December, multiply that times 3 months, and I have to accrue $1,600 of interest. Now in this example, and this is commonly done by banks, they use what's called a 360-day year, and if you divide 360 by 12, they average an average of 30 days per month. It simply makes calculations a little bit easier. Sometimes you may use 365 days, and in that case, of course, you need to know which months have 30 days, which have 31, February, 28, 29, whatever. So we're simply going to assume each month has 30 days for simplicity's sake, but recognize sometimes you'll use 360, sometimes you'll use 365. December 31st, end of the fiscal year, we have to make our year-end adjusting journal entry to accrue interest. We have to put 3 months interest expense on the income statement for this year, ending December 31st. And we calculated $1,600, same accounts that we debit and credit, debit interest expense, credit interest payable for $1,600. Interest expense is going to get closed out, set back to zero, temporary account. Interest payable sits on the balance sheet. Okay? And if we were to look at our general ledger, we would have a note payable for $80,000, and we would have interest payable, just abbreviate, for $1,600. Okay, well on March 1st, the maturity date, the due date, we pay back everything. The principal, $80,000, plus the total of 5 months worth of interest. Okay? And so let's take a look at the journal entry on March 1st. We're going to pay back the note plus 5 months interest. If you multiply $533 times 5 months, it comes to, and I rounded, $2,667. Okay, so here's how we record the journal entry. I'm going to cut a check to the bank for $82,667. Once I've paid off the loan, let's get these accounts, these payables, off of our general ledger and off the balance sheet. I'm going to debit notes payable for $80,000, so I have a zero balance. Now remember, this did not get closed out, so I have to debit interest payable as well to get that off my books because we've paid this off. We've satisfied this liability. And then I have to record 2 months' worth of interest for January and February in the following time period. Okay, 2 months go in the following year, 3 months of interest were recorded in the previous period. And we have to do this anytime we cross over a time period such as year end. So this loan was started on October 1st of year 1. It ended March 1st of year 2. As a result, we allocate 3 months of interest expense to this period, 2 months of interest to the following time period, following the matching concept, which is a rule that we have to follow in accrual-based accounting. Okay, so this is the journal entry we record at the maturity date to repay principal and all interest owed. Okay, so this is something I'd like for you to know for testing purposes. Other current liabilities. First, we'll take a look at sales tax. Okay, depending on where you live, you are probably familiar with your sales tax rate. Okay, I just arbitrarily picked 7% for this example. All right, let's take a look at 2 separate examples. In example 1, the sales price is $5,000. If the sales tax rate is 7%, then the store is going to charge me or the customer a total of $5,350. So the store would debit cash, and if we were the store, this is our store, we would debit cash $5,350, credit sales revenue, or just sales, for $5,000, and credit sales tax payable for $350. Now, sales tax payable is a current liability because the store, our business, we have to pay the state of California or whatever state we live in the sales tax because the government requires that we do this. And if they audit us and we haven't been paying our sales tax, we can get fined and we can get in trouble. So we are required by law to collect from the customer the sales tax, and then we have to remit it to the government, typically either at the end of the month or at the end of the quarter, depending upon the size of our business. The bigger the business, the more frequently you have to remit sales tax. Let's look at the second example. If we were told that the total amount collected was $6,420, so what they did was they put sales and sales tax together and said, here's $6,420, we need to figure out, well, how much of that $6,420 is the sales price and how much of it is the sales tax. So here's how we would do that, okay? Assuming the sales tax rate was 7% and we have to separate the sales from the sales tax, then I'm going to call sales X. I'm bringing back bad memories of algebra, I know that, but we're going to call sales X, and we know that sales tax is 7% of X, which is 0.07X, and we're going to add those two together, and so what we'll have is X plus 0.07X equals 6,420. I'm going to erase the board here, give you some visual space here. Okay, and so X and 1X are the same thing. So this comes to 1.07X equals 6,420. And to isolate X, we simply divide both sides by 1.07. So when we divide this by 1.07, we get X. We divide this by 1.07, and the sales was $6,000. If we multiply 6,000 times 0.07, we're going to get $420, and then we can reconstruct our journal entry. Debit cash for $6,420, credit sales or sales revenue for $6,000, and credit sales tax payable for $420. Okay? And of course, when we pay the sales tax to the state, we're going to debit sales tax payable, credit cash. Anytime you pay off a payable, debit the payable, credit cash. Okay? So sales tax payable is a current liability. Payroll. There are two primary journal entries related to payroll. The first, we record payroll for the time period. And second, we have to record payroll taxes that the employer is required to pay to the federal government, the state government, and federal agencies such as Social Security and Medicare. Okay, so let's take a look at an example to illustrate these journal entries. First, let's assume gross payroll for one time period is $100,000, and I just arbitrarily came up with some numbers. Federal income tax was $20,000 for this time period. State income tax was $8,000. And then FICA. FICA is Federal Insurance Contributions Act. A little bit of history. This came after the Great Depression in the early 1930s. And they created the Social Security system, which would, upon retirement, give people a base level of income so they wouldn't starve. Okay, and that's the general premise. Okay, and then later on, I think in the 60s, we created the Medicare system. And that's your health care, your health benefits upon retirement. So when we're working, we contribute into these two systems, and upon retirement, we have some level of security in terms of some money coming in and health care benefits. Okay, and that's the concept. So while we work, we put into the system. In retirement, we take out of the system. Okay, journal entry number 1. We record payroll expense, and you may call this wage expense or salary expense, but this is the expense for $100,000. That's the gross pay, total amount. This is what the employees actually earned. The laws require us, the employer, to withhold a variety of payments that are going to be made to various different government agencies. So we have federal income tax payable. That's going to get paid to the Internal Revenue Service. The state income tax payable in California, that gets sent to the Franchise Tax Board. Social Security payable will go to Social Security. Medicare payable goes to Medicare, the Medicare system. And then what's left is what goes into the employee's pockets, payroll payable, and we call that net pay. And again, that could be wages payable or salaries payable, whatever you want to call it. Now, you could have additional withholdings. You might have a 401k retirement plan. You may have to make some health insurance contributions. You may have union dues, long-term disability. So there's a variety of other withholdings that could take place as well. Okay, we'll simply stick with this example here. So gross pay, which we debit the expense, $100,000. Net pay, we credit the payable. And that's the amount we're going to actually pay the employees. And remember, this money came out of their pockets. The employer is legally required to withhold this money and to pay it to the various agencies, okay? And so there you have the first journal entry. In addition to this journal entry, we have the second journal entry for the employer's payroll taxes. The employer has 4 payroll taxes, and you need to know these. First, they have to match every single one of their employees' Social Security contribution and Medicare contribution. Okay, so Walmart, for example, has over 1 million employees. For all 1 million employees, they match each and every one of their Social Security and Medicare contributions. You pay half, the employer pays half. Okay, quick comment, if you're self-employed or an independent contractor, you have to pick up both sides. So you have to be aware of that. Okay, in addition, only the employer pays federal unemployment tax and state unemployment tax. Okay, so let's take a look at this entry. Okay, they match FICA. FICA is made up of 2 parts, Social Security and Medicare. And the employer only pays federal and state unemployment. Most of it typically will go to the state. They're the ones who actually cut the unemployment checks. And then the federal contribution is for emergency backup to certain states, as well as for administering the federal laws, et cetera. Okay, now again, I just simply made up some numbers to illustrate the point. Assuming federal unemployment tax is $1,000 and state unemployment tax is $5,000. And from the previous slide, let's just go back see what it looks like. Okay, there was $6,000 of Social Security, $1,500 of Medicare. Okay, so if we add up those 4 employer payroll taxes, that comes to $13,500. They will debit payroll tax expense, goes on the income statement, and credit Social Security payable, Medicare payable, federal unemployment tax payable, and state unemployment tax payable. Okay? And then they will cut those checks either at the end of the month or the quarter to the various different government agencies. Okay? Now, I just want to make one more comment, and if we go back to the previous slide, when we see net pay for payroll payable, when we actually cut the checks to the employees, we'll debit payroll payable and credit cash. This is a standard journal entry whenever we pay off a payable. Okay? So that, yes, that is a journal entry that relates to payroll, but when I refer to the 2 primary journal entries, first we record the actual payroll, and second, we record the payroll tax. Okay? So this is stuff you should be familiar with. Now let me just comment. I will provide you with any percentages you were to need to answer any questions. For example, as of this point in time, employees pay approximately 6.2% of their first $100,000 of earnings. It's actually a little bit more, but again, don't worry about those numbers. Don't worry about the cutoff point and the percentages. I'll give you that information. Where we currently stand, Social Security, each employee pays 6.2% of the first $100,000 or $106,000 of earnings. If you don't make that much money, then you simply pay Social Security for the entire year. If you earn more than that, once you hit $106,000 for the year, for the remainder of the year, you don't have to pay Social Security, so you'll see a few more bucks in your pocket. Medicare at this moment in time is 1.45% of all earnings. There is no ceiling, no cutoff point for Medicare. And again, these percentages most likely will change in the future. For unemployment taxes, and again, don't worry about these numbers. In California, the employer pays about up to 5.4% of the first $7,000 of each employee's earnings. So it's not as much of a burden. Once that employee has earned $7,000 or beyond that, there's no more unemployment tax. And the federal unemployment tax is a little bit less than 1% of the first $7,000 of each employee's earnings. Okay? So I simply wanted to mention that. I would provide you any numbers and percentages, etc. You would need to know that Social Security does cut off at a certain point. Okay? Other than that, don't worry about percentages and the dollar amounts like $7,000 of earnings, etc. Unearned revenue. When you have a magazine subscription, you typically pay in advance, and then each month or each week, depending upon the frequency of the magazine, as the company mails you that magazine, they can then recognize revenue because they've earned it. You typically buy airline tickets and book hotels and pay for them in advance. Okay, so the airline and the hotel will record unearned revenue, and when you land safely or you've slept in the hotel and finish your stay, then they recognize the revenue. We're going to do an example momentarily. Same thing with season tickets to your sports team or the opera or whatever it is you have season tickets for. You pay in advance, they record unearned revenue, and once they've provided the entertainment, then they recognize revenue in accordance with the revenue recognition rule. Okay? So record the unearned revenue when we receive the cash, and we adjust unearned revenue. And remember, unearned revenue is a liability. It's a current liability. Even though it has the word revenue in there, it's a liability because it is unearned. We don't recognize revenue until we've earned it. How do we earn it? We provide whatever service that it is that we provide. Okay, here's an example. On November 1st, a customer pays us, my company, $1,000 to paint his house. So I receive $1,000, I debit cash, and I credit unearned revenue for $1,000. Again, unearned revenue is a current liability. In December, the following month, I paint the house, and as a result, I've earned that money, so I have to record an adjusting journal entry. I'm going to debit the liability. Remember, in my general ledger, here's unearned revenue. I have a $1,000 balance. Once I've earned it, I'm going to eliminate this liability because I've satisfied it. I don't owe him $1,000 of service. I simply have done the work, and now I'm going to credit service revenue, which goes on the income statement because I've performed the service. I've earned it. That money's mine. I did the work to their satisfaction, and by adjusting unearned revenue to recognize revenue earned, we now have transferred the money into the revenue account on the income statement. Okay? And so unearned revenue is most commonly a current liability. Okay, and that's it for the current liability section. We'll look at non-current liabilities in our next lecture.